Beating the Street, Golden Lessons, Peter Lynch's Fundamentals. Peter Lynch is considered one of the most successful investors in Wall Street history. During his time managing the Magellan Fund at Fidelity, he achieved average annual returns of around 29%, turning a modest mutual fund into the largest in the world. His writing in Beating the Street is filled with practical wisdom for everyday investors, not complicated theories, not academic formulas, but real strategies that anyone willing to think and research can apply. Lynch fundamentally believed that regular people could beat professional investors because individuals have the advantage of flexibility, curiosity, and real-world observation. His first golden rule: invest only in what you understand. Lynch explains that investors constantly fall into trouble when they chase the next big thing, without knowing how it actually works. If you can't explain in simple words how a company makes money, you have no business owning its stock. For Lynch, understanding means knowing what products the company sells, who their customers are, and why those customers will continue buying in the future. He famously came up with many winning stock ideas during everyday life, while shopping at malls, pumping gas, or talking to family about the products they love. This leads to his concept of, buy what you know. If your kids rave about a new toy brand, if your partner constantly buys the same cosmetics, if you see a restaurant always full, that's first-hand research. Most small investors ignore these signs and instead choose companies they've never interacted with, simply because the media talks about them. Lynch shows that your everyday experiences in the real world can give you investing advantages long before Wall Street notices. However, Lynch emphasizes that knowing a product is only the beginning. A great story must be backed by great numbers. That's why one of his strongest teachings is, the company story must make sense. Investors should always check fundamentals, earnings growth, price-to-earnings ratio, P/E, debt level, cash flow, and profit margins. A booming product with terrible financials can destroy shareholder value, just like a boring product with strong financial discipline can be a hidden gem. Lynch warns against buying fashionable stocks at high valuations. When everyone is talking about a stock, its price is often too high to provide safety. Instead, the best opportunities are usually among companies that Wall Street does not pay attention to, the hidden champions. He categorizes companies into 6 types: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Each category requires different expectations and investing tactics. For example, fast growers, like early-stage tech or restaurant chains, must be monitored for sustainability. Rapid expansion can turn into rapid decline if management loses focus. Meanwhile, stalwarts, well-established companies with strong balance sheets, may not double overnight but provide stability and reliable compounding returns. One of Lynch's most underrated teachings is that patience is the investor's ultimate advantage. Many people lose money because they get scared during downturns and sell too early. Lynch states that, the real key to making money in stocks is not to get scared out of them. If you've done your research and believe in the company's long-term potential, short-term market fear becomes an opportunity to buy more, not a reason to sell. Lynch also insists on the importance of constant learning. A good investor must update their thesis as a company evolves. If the fundamentals change for the worse and the story no longer works, you need the courage to sell, even if the price has dropped. Lynch rejects the idea of falling in love with any stock. Another core lesson in Beating the Street is diversification, but not excessive diversification. Lynch calls over-diversification diversification. Buying too many stocks adds complexity without improving performance. Lynch suggests owning enough companies to protect your portfolio from disaster, but not so many that you can no longer track them effectively. He says, know what you own and know why you own it. Every stock in your portfolio must have a clear purpose. Dividends play a major role in Lynch's strategy as well. Strong dividend growers signal stable profits and disciplined management. Reinvesting dividends is like planting seeds that grow into trees, compounding over time. Above all, Peter Lynch rejects emotional investing. Fear and greed destroy returns. Instead of reacting to market noise, investors must focus on business performance. He reminds us, behind every stock is a company. Find out what it's doing. The media may hype daily price movements, but companies do not change value overnight. Lynch's framework empowers investors to separate real value from market rumors. In summary, the first golden lesson from Beating the Street is simple: the stock market is full of noise and hype. The investor who stays grounded in real-life experience, strong business fundamentals, and long-term patience can beat even the smartest professionals. Investing is not about guessing the future, it's about understanding the present. People who are curious, disciplined, and willing to research are the ones who consistently win. Lynch proves that everyday investors, people who observe the world closely, can turn ordinary knowledge into extraordinary wealth. And the most important step is to simply start. With knowledge, discipline, and a strong mindset, the average person has far more power in the stock market than they realize. Peter Lynch's second great category of golden lessons from Beating the Street revolves around turning observation into action, transforming everyday insights into powerful investment decisions and understanding how to evaluate growth in its most realistic form. Lynch argues that Wall Street often gets blinded by short-term trends, while real clues about future winning companies are hiding in plain sight for ordinary people. He constantly reminds investors that the next 10-bagger, a stock that multiplies 10 times in value, might already be in their neighborhood, gaining popularity long before analysts notice. But identifying it early requires a deep understanding of the company's DNA, especially growth. According to Lynch, growth must be earned, not assumed. A company that expands rapidly without matching operational efficiency risks collapsing under its own weight. That's why Lynch stresses that the best growth companies are profitable, well-managed, and solving simple real-world problems. He warns against being dazzled by complex technology that most consumers don't want or understand. Instead, he encourages focusing on companies that make life easier, cheaper, or more enjoyable, businesses with products that sell themselves. This leads to a crucial principle: growth must be sustainable. Lynch explains that many companies grow quickly for 1 or 2 years due to temporary excitement, aggressive expansion, or market momentum, but then fade just as fast when competition intensifies or mismanagement spreads. Therefore, investors must verify that a company is growing in the right way. Store openings only matter if those stores remain profitable. Increasing revenue only matters if earnings and cash flow grow too. Market share wins are meaningless if the industry itself is shrinking. Lynch lays out a simple but powerful checklist for spotting sustainable growth. Is the company gaining customers consistently? Is its balance sheet strong with manageable debt? Are its profit margins stable or rising? Does management reinvest earnings intelligently or waste capital? Can products maintain excitement without constant marketing overspending? Do insiders, the executives, own shares themselves, showing confidence in their future? By applying these checks, investors filter out weak growth disguised as success. Another major theme Lynch emphasizes is the advantages of small companies. Smaller businesses are more capable of doubling their earnings or expanding into new geographic regions because they start from a smaller base. A giant corporation like Coca-Cola cannot triple in size quickly, its global reach is already enormous. But a regional restaurant chain or niche retailer could go national and multiply returns for early believers. Lynch encourages investors to seek these promising underdogs, companies Wall Street ignores simply because they seem too boring or too small. He famously describes this as finding opportunities before the institutions do. When a company is too small to be noticed by large investment funds, its stock price often sits undervalued. That's when retail investors have a unique advantage: they're allowed to buy early, before demand explodes. The moment major funds take notice, the price skyrockets, rewarding the patient small investor who saw the future first. Yet Lynch warns that not all small companies are treasures. Size alone does not guarantee success. The management team must be smart, growth must be realistic, and competitive advantages must be defensible. Lynch looks for repeatable success, proof that a company can expand the same winning business model into new locations or markets without losing quality. This is why he values companies with strong branding or customer loyalty, assets that competitors struggle to copy. Additionally, Lynch highlights that growth companies often experience volatility. Their stock prices swing heavily because investor expectations are high. But volatility is not risk, misunderstanding is risk. If an investor understands the company thoroughly, its products, customers, and long-term roadmap, market dips become opportunities to add more, not sell in fear. Lynch frequently states that downturns reveal the difference between gamblers and informed investors. If you only bought into hype, fear will make you sell. But if you bought into fundamentals and a convincing future, fear becomes your friend. Another of Lynch's overlooked teachings is that good growth companies rarely rely on hype to communicate progress. Show me, don't tell me, he insists. A truly strong company demonstrates results through consistent numbers, not bold promises. Lynch distrusts businesses that constantly talk about future projections rather than celebrating current achievements. He also avoids companies that frequently change their story. Pivoting business focus is often a sign that management is confused or desperate. A consistent vision is one of the strongest signals of trustworthy growth. Lynch also teaches the importance of identifying growth barriers early. He calls these choke points, the limits to how far a company can expand before hitting major resistance. These might include limited market size, dependence on one product, supply chain weaknesses, or vulnerability to economic cycles. Great investors must ask, what happens after expansion? Can this company continue winning for many years? Lynch often conducted hands-on research, visiting stores, trying products, evaluating customer experiences, long before reading analyst opinions. Observational research helps investors assess whether customers truly love a business or if popularity is just a phase. If you see a restaurant always crowded, that's momentum. If lines grow even when competitors open nearby, that's loyalty. If customers recommend products without being asked, that's conviction, and conviction fuels growth. Lynch also warns that not every winner looks like a winner at first. Many legendary growth companies start as small, misunderstood businesses solving niche problems. Wall Street may dismiss them because they don't fit popular narratives, but investors with sharp observation and curiosity can uncover future stars. This idea fuels one of Lynch's most empowering messages: anyone can discover great companies if they pay attention. Your workplace, your hobbies, your shopping habits, all are sources of investment intelligence. A nurse may spot the next breakthrough medical device before investors do. A parent may identify the next hit children's brand from product popularity at playgrounds. Lynch says, trust your eyes, trust your experience, trust real-world evidence. Ultimately, Part 2 of Lynch's golden teachings emphasizes turning attention into conviction, and conviction into action, with thorough research to support curiosity. Every great investment starts with noticing something others ignore. The stock market eventually recognizes remarkable companies, but those who spot growth early enjoy the biggest rewards. Lynch proves that the world is full of opportunities waiting to be discovered. The question is, are you looking? Selling is the hidden half of investing, yet the part most investors struggle with. Buying feels exciting, hopeful, a bet on a better future. But selling? That means admitting something changed, either the investment grew into something beautiful or it turned into a mistake. Peter Lynch believed that the ability to sell wisely is what truly separates amateurs from professionals. If you buy a stock with a story, you must remain a vigilant storyteller. When the story breaks, it's time to act. Lynch warned investors to avoid the trap of falling in love with a company. You may admire its brand, appreciate its products, or enjoy telling friends that you picked it early, but the market doesn't reward nostalgia. The question isn't, do I still like this company? It is this still the same business I invested in? Lynch's first sell trigger, the reason you bought is no longer true. If a fast-growing company stops growing, it can no longer justify a fast grower valuation. If a turnaround signs of hope reverse and the decline resumes, the turnaround story is dead. If management shifts from smart capital allocation to reckless spending, the culture changed. As Lynch would say, if the business shifts from dream to nightmare, don't stay to watch the horror. This requires discipline, because our brains hate realizing losses. Investors cling to the fantasy that it will come back, as if the stock owes them forgiveness. Lynch argued that a losing investment should be sold precisely because it frees capital for better opportunities. There's an opportunity cost in stubbornness. Meanwhile, what about selling winners? This is where Lynch's wisdom becomes unconventional. Most investors sell too early, they panic at small gains and lock in tiny wins while holding on to huge losses. Lynch flipped this logic. If a good company keeps delivering growth, why cut its wings? The hardest move in investing might be holding long enough to find a 10-bagger. Those rare stocks pay for all the failures and more. Lynch insisted that investors must continually check the company's growth drivers. Is demand expanding? Are new stores profitable? Is the competitive edge widening? If the answers are yes, he saw no reason to sell. Another major sell trigger, dangerous debt. He constantly warned about companies whose debt balloons faster than earnings. Leverage can make the share price look cheap until reality catches up and destroys equity. Rising debt without rising cash flow is a flashing warning light. Lynch also monitored inventory, especially for retailers and manufacturers. When inventory piles up, it silently signals that products are not selling. And if customers aren't buying, investors shouldn't either. One of Lynch's favorite red flags was diversification, when companies wander into businesses they don't understand. A restaurant chain buying a software company? A toy brand acquiring oil rigs? These are ego-driven expansions that usually end in value destruction. He sold when CEOs lost focus. Finally, Lynch believed every investor must remain humble. You will be wrong, maybe often. That's normal. Mistakes are tuition fees for financial wisdom. The danger isn't being wrong, it's refusing to admit you're wrong. A key line he repeated: if you've dug yourself into a hole, stop digging. Selling a mistake sooner means preserving capital to capture the next big winner. The ultimate goal is not perfection but progress, replacing bad ideas with better ones. Lynch never sold based on market fear, headlines, or doomsday predictions. He sold when the business fundamentals cracked. His philosophy: buy great companies, monitor the story, and act decisively when facts change. Holding is a superpower. Selling is an art. Judging a business honestly is a discipline. Master all three, and you step into the realm where average investors become exceptional ones. Thank you for watching this deep dive into Peter Lynch's wisdom and the art of knowing when to sell a stock. Investing is not only about choosing great companies, it's about continually evaluating them and having the courage to act when the story changes. If you found this video valuable and want to continue learning from the greatest investors of all time, make sure to subscribe to the channel. Your support helps us bring more high-quality educational content to help you grow as a smarter, more confident investor. See you in the next video.